I've noticed these big inflows into the mega cap funds here, Vanguard, mega cap growth, some of these other ones that are out there, S&P 500, the S&P 100 ETF. A lot of this seems to be the interest in big cap that I was talking with Matt about, but there's also seems to be a lot of interest just in buying into the internet stocks that are going to really do well in this environment. Obviously, we've seen Amazon and Apple and Facebook do well. You've got one, OGIG, one of the O'Shares, the global internet giant. I was just looking at the inflows the other day, quite phenomenal in the last couple months. What do you think is going on with that? And tell us how that fund is doing.
Well, what that fund does is realize that the FANGs are not unique to our own domestic market. There are companies all around the world, over 50 of them, that are experiencing tremendous growth as a result of what this whole pandemic has done to global retail changes. I mean, people's propensity to buy online is not just domestic anymore. We went into this at 16.2% online sales pre-pandemic. I think we're coming out at probably 24. So OGIG is not market cap weighted. So, you know, the trouble with a lot of different indices is they're market cap weighted. So the FANGs represent 44%. But the FANGs are not the fast growing internet stocks anymore. You can find all kinds of companies like Zoom, like DocuSign, like JD, all kinds globally. And that's what's captured inside of OGIG. It's up 21% year to date, Bob. It's our best performing index, but it's captured the theme that I think is going to stay intact for the next 3 years. People are going to keep buying online, and these are the global internet giants encapsulated inside of OGIG and not market cap weighted. So you get lots of all of the stocks that are performing well, not just the FANGs, which are included in OGIG, but they're not 44% of it.
Yeah. Yeah, this is a debate that's been going on for many, many years. Sometimes you get lucky. Like if you look at the biotech stocks today, you see the two biotech ETFs, IBB and XBI. One is market cap weighted, the other is basically equal weighted, and they're both at new highs. But that doesn't happen a lot. Usually, equal weight or market cap weight does a little bit better. And recently, market cap weighted in tech has done a lot better. So that's a very good point, Kevin. Thank you. Matt, there's a lot of bottom fishers out there. It never ceases to amaze me. We were talking last week about the inflows into jets. This is the global airline ETF. It's essentially a basket of U.S. airlines. There's some international ones in there. But the inflows have been titanic in the last few weeks. Inflows into XLE, which is the energy ETFs. You think people would realize now picking a bottom and this is a fool's game, and yet we're still seeing it. The urge to pick a bottom does not go away, and you can see it very clearly in the behavior of some of these ETFs recently.
Yeah, I mean, as I always say, trying to pick a bottom in energy stocks requires a steel stomach, and we are seeing basically that play out right now. I mean, that's what the flow trends are telling us. In February and March, we saw strong inflows in energy sector ETFs, but those flows were from investors wanting to go short. Short interest on XLE climbed to around 20% of its assets. But here's where the bottom calling comes in. Short interest has declined since then and is now just around 11%, but the inflows into energy sector ETFs haven't stopped. There was about $1.1 billion in April, right as the sector rallied 30%. We are seeing some of the same trends within those airline and energy commodity ETFs you mentioned as well. Those strong flows alongside declining short interest point to bullish optimism on some of the more beaten up spaces like energy. And as we said earlier, you take those trends along with inflows into sectors with strong earnings like healthcare and tech, and to me it shows that investors are picking their spots when buying the rally.